Hello and welcome to OptionSizzle.com. My name is Joshua Bellinger, and in this video, I am going to share with you what a covered call strategy is and the best way to use it, with Monster Worldwide being the example. So the first thing I want to walk you through is I am a technical analysis, and I use candlesticks, and I'm looking at levels, and that's the way that I trade. Monster Worldwide does have a fundamental story, and it is Friday, September 28th, 2012. And if we take a look at today's price action, you notice that it was a little bit of volatile today, and some volume picked up here. For technical analysis or technical readers, a lot of individuals would look at this and look at this as a bear flag. What we want to focus in on is the overall trend that it has been in, and I'm going to delete some levels that I have drawn here. And if we look for the last year, it's pretty much been in a range. This is a year chart, and from $10 to about $6.40, this is the level that it has been in. So keeping this in mind, looking for strategies or trying to find stocks for good strategies, this one I come across on a Friday because there were some calls that were being picked up. I follow unusual option activity, and late in the day there was a spike in prices. If you look here in the daily chart, you can see there was a big spike, and the reason for this spike is because there was some news, and here's the news that came out a little bit later, about 8 minutes into the close, that that's the alert, but this is the reason, supposedly the reason, because Deal Reporter, which is a website, issued that they're in talks with a private equity firm. That's what a PE firm is. Well, Monster Worldwide has had this news out for some time, and it's actually been out since right about here in February and March. Actually, this is when the news first came out, and we picked up that unusual option activity, or I picked up that unusual option activity, and one of the things I talked about was that because this is a legit story, that this is a press release from the company that this was heavily shorted and it's likely going to move up into 10. That's what exactly happened. But what does happen is that when there isn't a deal that does come through, because this is all the way back in March and now we're in October, deals take some time to occur, but they have been in talks or has had this vague press release being recycled many times. And what happens is that a lot of traders will try to use that to pump options. It's kind of a pump and a dump, pump and a dump. So the prices go higher and then they dump them, and it's just like what we saw here on the daily chart. You get a spike higher and then bam. And this is a 1 minute chart. You get a quick move, and the only people that benefit from this move are the people that got in before it, if there were anybody. But they get a quick move and then they fall right back down. And the reason that is because there's no legitimacy to the story. Well, this, when we're looking, or when I'm looking for trades, I think about the best trade available, or the best strategy available to use on a specific name to have the best outcome. This leads me to what I want to share with you, is what's known as a covered call strategy, and something to keep in mind in the future. So if we look here, we have the option chain, and we have October, which has 21 trading days left in it. And you could see with prices at $7.33 that the October 8th call is trading 45 by 50 cents. And because of that news that came out, there was a little bit of spike in implied volatility from the day before, which is the market moving and pricing these options much more expensive, which would be a benefit to be a seller, because what could happen here is that and we look at the chart here, is that the beginning the story was legit. Now it's just kind of recycled, and what happens is that the market moves in and people try to sell it. But what we don't want to do is that there is a real story behind it, and this company could get taken over. So staying short calls are not really idea. However, getting long calls might not be the same idea as well, because we don't know how long a deal can take. Deals can take a while, and when we look at option activity, one of the things that you always want to focus in on is where are they coming in at. Well, a news like that, they have these October contracts. We don't see smart money coming in here. We do see some December options here. And real quickly, I'll look at the time in sales, and I note that I do see these November 6 puts being sold here, with the October 6 being sold as well. And I do see some December 8s, which I was just looking at, being bought on the offer. So with that, that's given us a little bit of information, a bit of a blueprint of what we can expect. Now, if they're selling the 6 calls here, or the 6 puts, they're looking for prices to stay above 6 going into November expiration, and or looking to take the stock at a discount if it dips below $6, because they might be looking at the chart here and saying, well, it's been in this level, in this range, and that would be a discount to the market, and that they would get comfortable getting long stock there, and potentially playing for a takeover longer. We don't know exactly what the outcome is, but that's the only things that we can think about in trying to piece this together. What leads me to my idea for this going forward is that when we look here at the 8s in November, that's about 50 days. So there would be some time that we would chew up some money, or hold some money, if we bought stock and we sold calls, and that's what a covered call strategy is. So if we click on these and we actually go to a covered stock, and I'm using Thinkorswim for this, and you can do it in any platform. You might have to piece it together, but what we see here is that we can buy 1,000 shares of stock, and the stock price would be, if we got it right here, at $7.33. Now, we need to get short that same amount to have this as a covered call right, or a covered call strategy. It's either or. And because 10 contracts represent 1,000 shares, because one option contract is equivalent to 100 shares, so that would equal 10 contracts. You could see here that we show a debit of $6.93. So what is going on here is that we're taking in the premium because we're selling these options here, and it's reducing our overall cost. So if we come back and look at where $6.90 is, we could see that $6.90 is going to be right at this level here, right where my cursor is at, and I'll draw a little price level right here. So we have it right about there. Well, what this allows us, and what it could potentially set us up for, is an opportunity to play this potential takeover, or this level. If we look at the overall range that the stock has been in, we're pretty near the bottom end of this range here, and it could roll over, but we could get a free opportunity to take advantage of a potential buyout. So if we purchase shares at $7.33 and there is a buyout that does occur within the next 21 days, we would have the difference between $8 and $7.33 as our profit. So if we try to determine what a percentage return this might give us, let's bring the calculator here, and we'll just take $8 minus $7.33, which equals 67 cents. So let's calculate the percentage if that were to occur. So let's say if there was a buyout that came, or that occurred in the next 21 days, and or if prices just move higher. Let's just say prices just kind of come back into this level. It is resistance, and it is coming right back in there, and we have 21 days, and let's say prices just kind of moved a little bit higher and potentially went through this level or right at it. And that's what we'll use as an example, because we could still make money if the options do expire worthless because we took in that premium and the options or the stock just kind of trades and holds on there. We do cap the upside, so we do not have anything more above $8, but when we calculate the percentages, we want to know exactly what we could be making in the next 21 days. So if we just take the 0.67 and we divide that by 733, we get about a 9% return. So in the next 21 days, we can make a potential 9% return. And if we keep that in mind and understand if we took 50 cents on that premium that we took in, or that if we sold those options for, and that's considering that we sell it here on the offer. If we were able to get a fill on the offer, we take in 50 cents. So we take 7.33 minus 0.50, and that gives us 683. So 683 is where we would start to lose money. We have protection to the downside. Well, I'll show you and teach you a little trick here. Whole numbers are typically going to be levels that a lot of stops are at, or a lot of people will aggressively try to target because they think there's a lot of stops there. Well, 690 is typically a good level to always look at, a 90 level. So always look, and no matter what the number is, if it's 690, 590, 90 cents, so if it breaks $1 and goes to 90 cents, or if it's $100 and it goes to 99.90, always look at that 90 level, because that's a typical level that prices will push into, but then start to see a little bit of reversal. It's likely going to oscillate around that area, and if it does break that, then it's going to look and probably push lower, and that's where you don't want to be part of. So if we put a stop at that level, that 690 level, we can actually make a little bit of money. We might make 7 cents on the trade, because what could occur is that when we look at these options, so what would occur here is that these options would go down in value. So we would be able to buy these options cheaper. So we can put what's known as a contingent order. So with that, we would have this order in, and instead of buying it, we would actually have a different type of order where once the stock triggered, we have a stop set at 690. The order would sell the stock and also buy those options back. If not, you can let them expire worthless, but it would require margin. So what that would look like is you would sell the stock here and you would have a limit order. So if we let me find this here. We could just actually just click on the stock here. So we just click on that, and we have, if we did that 1,000 shares, and we would put a limit order in right away. So 690, that's the limit order. And we would do an advanced order. So in this specific trading platform, you can have a one triggers all, or one triggers an OCO order. So what would happen is here you could do a first triggers all, which then you would add another order to it, and then you would have the options bought back to cover that whole position if it were to drop back. So that's how you would protect yourself to the downside, and that's what we're looking at here. Because if this were not to follow through to the upside, and if the news wasn't real or it never anything occurred and it rolled over, we don't really want it to roll over and go against us too much. This would be a lot better if we can get it at, if this were a little bit lower and was right at the 650 level, and right into a really nice support level. 650 would be the ideal level. But for a position, if this is something that you wanted to speculate on this Monster Worldwide news, and that if there's some kind of private equity talks in works, or something that you think down the road would occur, and you want to take advantage of that, you own the shares, and then you sell stock against it to reduce your cover. So coming in August, or in October, prices are here, and the options expire worthless, and then you look to sell November, and you keep doing that. Or if it does get taken away, if no deal ever comes and prices do move higher, the stock will get taken away from you above $8, and you make that 9% return over the weekend, or over the course of the next 21 days. So that is the best way, I think, is to use the cover call strategy. Is one of the 3 ways I actually think that is the best way. You want to get the stock near a support level, and you want to sell potentially the options that are right at the strike. If you even look to sell these options, let's say, you could still make a pretty nice return. You sell these at 95 cents, and if the stock were to hold $7 or more, you would take in all this premium that you collected here as well. So let's say the stock, didn't move anywhere; it just moved between 7 and 8, and that's where you thought the range was going to be for the next 21 days. Well, that's a pretty decent return for 21 days. You're taking in more credit, but you don't have as much upside as you do with the 8 calls. So what I wanted to share with you is just my thought process and a little bit of a strategy with you to be able to help you become a better trader and utilize some of these option strategies that you can tie with stock and still enhance your overall returns with very limited risk. Having this opportunity with the options and using the stock and having some kind of news such as this Monster Worldwide provides a lot of opportunities, and sometimes you want to find the best strategy to utilize to create that profit. So if you have any questions, feel free to leave them below, and until the next video, thank you for watching.